Okay, so let's get started with our discussion of Chapter 22. This is Professional Liability and Accountability is the name of the chapter. So when we think about this chapter, we want to kind of think about the chapter that really is one of the more important chapters for this course, in the sense that it does cover content that's tested on the CPA exam, but also it's an exercise in managing liability for professionals, namely accountants, since that's the target audience, if you will, but also other professionals. All right, so there's a lot of good information in this chapter. The first module that we'll discuss is professional liability as it relates to clients. All right. Okay. So when we're talking about liability for the clients, presumably of the accountant, we want to think of three sources. Now, there's some overlap here. A lot of this we've already covered. Some of it is 2080 stuff. Actually, all of these concepts should have been covered in 2080. We'll briefly run through them. But the first theory is breach of contract, right? So we've had a couple of chapters on contracts already this term, and you've had a few in 2080. So, basically that's failing to live up to your contractual promise, and courts suggesting damages are a remedy to correct that deviation from the contractual promise. All right, and it's the same thing with professionals. So if you fail to live up to your contractual agreement, you can be held liable for damages, and that can typically includes general damages, special damages, or consequential and compensatory damages. All right, it can include punitive, but generally for breach, we don't see. It's rare to see punitive damages for breach of contract. Usually, those are for more egregious things. All right, negligence, also something covered in your intentional tort chapter in 2080. And you may remember, if you had me, you remember the mnemonic I like to use, the ABCD, which is a duty owed, breach of that duty, which causes damages, right? Those are your four elements of a negligence claim. When we're dealing with negligence of a professional, we often call it malpractice. So if you see that term, it's commonly used in medical or legal fields, but really and truly, malpractice is just professional negligence. So any profession that requires registration with the state as a professional, so that would include definitely doctors, lawyers, accountants, but it would also include morticians, barbers, estheticians, fingernail technicians, anybody who has to register with the state to have a license to do their business is technically a professional, and when they are negligent, it is malpractice. It just means that the standard that their behavior is compared to is not the standard of the reasonable person, rather the standard of the reasonable professional. Okay, fraud, right? And I've got a slide devoted to fraud, so we'll move. And we'll get back to fraud in just a moment. I want to talk a little bit about negligence, particularly as it relates to accountants. So, as you know, we have accounting standards, GAAP, which governs accounting reporting, recording of transactions and reporting thereon, and then GAS, which is generally accepted auditing standards, which governs financial statement and compliance audits. All right. So, since we have these standards, it's kind of a double-edged sword. So a violation of the standards is pretty much a slam dunk negligence case, right? It's a prima facie evidence of negligence behavior, right? If I'm doing an audit and I haven't lived up to a gas standard, it's a negligent audit, and I'm going to be liable for repercussions that come in the aftermath of that audit, because that's negligence. I didn't live up to the standard. However, and I said this is a double-edged sword, the other side of the coin is merely doing what the standards say needs to be done or must be done doesn't mean you're not negligent, right? Because you're still held to the level of prudent professionals and what they would have done. Prudent or reasonably prudent professionals and what they would have done. And if an injured party or a plaintiff is able to demonstrate that the reasonable accountant would have gone above and beyond what the standards mandate as the minimum, then you could still be found negligent and liable to your client for breach of that duty, because you didn't live up to the standard of a reasonable auditor or a reasonable accountant. All right, so that's an important distinction to keep in mind for this chapter, obviously for the CPA exam, but also it has real world application, because if you're on an audit and you say, well, we've complied with the standards, we're golden, let's punch off and hit the bar, happy hour. Doesn't really work that way, right? Because if it's later found that whatever risk factors you assessed would have caused the reasonable accountant to do more work, then you got to do more work. Okay. Defenses to negligence. Now, I put in some common speaking here. I hope you guys don't mind. The first defense, or in Shaggy speak, it wasn't me. All right. Basically, I wasn't negligent, right? And in this case, the accountant would need to show that they did, two things. They did meet compliance with GAP or GAS, whichever would be appropriate, and also that they lived up to the standard that reasonably prudent accountants, CPAs, or auditors would have given the circumstance. All right, so that's your first defense. I wasn't negligent, Second defense, yeah, but, or so what? All right, which is, I may have been negligent, but that was not the cause of the loss. All right, so this focuses on that causation element. As you may recall from 2080, if there is no causation, or if the negligent act didn't cause the loss of the damages, there's no liability. You don't have a solid negligence case, and that's the argument here. Yeah, this may have been negligent, but that's not what caused the financial loss or the fiscal injury that the client is seeking redress for, or seeking recourse for. All right. The third defense first. Kind of sounds like you're tattletelling, but that's the third defense, right? The client was also negligent, and that often is in my experience, is the most common defense, because oftentimes the most difficult audits are the most dangerous ones, and the most difficult audits are the ones where the clients have not closely adhered to GAP, and the audit is basically wading through a minefield and trying to make it to the other side intact, right? So that is also a common defense. The client was also negligent, and their negligence played a factor into the loss or the injury. All right. So let's talk a little bit about fraud. And again, you've covered this in 2080, so I'm not going to get knee deep in it. But let's start with the elements of a fraud claim: misrepresentation of a material fact, intentional misrepresentation of a material fact with an intent to deceive. So I'm misrepresenting something because I want you to have bad information to make a decision that presumably favors me or my client. All right. Justifiable reliance by the innocent party. All right. This means that the party not making the misstatement or misrepresentation does in fact rely on that information, at least in part, to make a decision. For our purposes, we're talking about a financial decision. All right. And that it's reasonable, right? We use that word a lot, that a reasonable person would have relied on that information as well. In other words, if you're lying to me and I know you're lying to me and trying to misrepresent, I don't have a claim for fraud because I'm aware that you're full of fecal matter, right? And so if I know that you're lying, I can't then sue you for fraud, at least not without perjuring myself. All right. So those are the elements of a fraud claim, and let's not forget about this because that's important. The reliance must have been reasonable, right? To use an illustration, if I'm buying a used car and it's in bad shape, you can tell the car has got some miles on it. So let's say it actually has 415,000 miles on it, but you look at the odometer and it's got 15,000 miles on it, and you look at the car and there's no way it's a 15,000 mile car, but that's what the salesperson represents. Well, I'm not going to be able to sue for fraud because looking at the car you can tell it's been through more than 15,000 miles, right? It's not, a reasonable person wouldn't have relied on that because, it's common sense that this isn't a 15,000 mile car. So that's an example of where perhaps the first two elements are present, but the third would be lacking. In that case, you wouldn't have a case for fraud. All right. Actual fraud, which is really what we've been talking about. Intentional misstatement of material fact that injures the client. Of course, injure is the legal definition, which can be a financial loss, physical injury, loss of or damage to reputation. Any of those will fit in that category. All right. Constructive fraud we always talk about with fraud, but technically constructive fraud fits a little bit better with negligence because constructive fraud is gross negligence. All right. To keep it relevant, gross negligence in the accounting realm would be starting an audit on a trial balance that does not balance. Right, that goes beyond negligence. Right, negligence is an accident. Constructive fraud or gross negligence is to take some action that is so, I want to say stupid, but just so has such a disregard for common sense that it is grossly negligent. Right. So when you hear constructive fraud, think of gross negligence, or sometimes we use the word recklessness. All right.